Good morning. Thank you very much for joining us today. In the past few weeks, as most of you know, there have been a number of different measures announced by government and the private sector, which aim to provide financial support to companies hit by the current crisis. ScotlandIS has helped provide input from the digital technology sector to make sure these measures work to provide appropriate support for the companies in our industries. While a range of options is important to make sure that support is available for various scenarios, it's inevitably a bit confusing and currently changing on a daily or weekly basis. And everything is happening so quickly, it makes it even more challenging to keep up to date with all of the changes. So in today's session, we will run through the support packages which are relevant for the digital technology companies to give you a bit more understanding of what's there. We have a number of excellent speakers to help us with this. We've got Stephen O'Neill and Sarah Payne from the Digital Economy team in the Scottish Government, and they will talk to us about the Pivotal Enterprise Resilience Fund and some of the other policy measures that the Scottish Government have put in place. We have got Paul Atkinson. Paul, we're delighted to have you again, who's a founding partner of VC company Power Equity, and will give us an overview of options, including the initiative Power Equity have developed with the British Business Investments. We'd also like to welcome Chris Thompson this morning from Anderson and Brown, who will cover coronavirus business interruption loans and grants available from local authorities. We will also, between the panel, fund questions on the Future Fund if we can. So without further ado, I would like to hand over to Stephen and Sarah. They have to leave us slightly before the end of the session, so we will open up for Q&A before they have to go. We'll then hand over to Paul and Chris, and we'll happily take Q&A at the end of the session as well. So if I could now welcome Stephen and Sarah.
Thanks very much, Jane. I'm not sure Stephen's managed to join in as of yet, so I'll crack on with my part of it, which is the Pivotal Enterprise Resilience Fund. So this is part of the £100 million support package of additional grant support for small and medium-sized businesses and newly self-employed people that was announced by our Cabinet Secretary last Thursday at 2 p.m. So the relevant portion of this is a £45 million Pivotal Enterprise Resilience Fund, which aims to support viable yet vulnerable SMEs, and it's all about protecting productive capacity in Scotland's local and national economies, which are crucial for economic survival in Scotland. So I'll talk a little bit about what we mean by pivotal enterprise, but first of all, some of the kind of hard eligibility criteria. So this is for SMEs, so it's companies up to 249 employees that have been trading for more than 12 months. We require that companies can demonstrate that this funding will support them to be viable for at least the next 6 months. They mustn't have been in financial difficulty before the 31st of December 2019, and they must have a business bank account. So they're the sort of hard eligibility criteria, but so as I mentioned, this fund is about protecting Scotland's economic capacity. So what do we mean by kind of pivotal, crucial in that sense? So we recognise that Scotland's subnational economies look quite different, and so what is a pivotal enterprise looks quite different across the country. So as a result, this fund has quite a lot of discretion. So it's going to be delivered by different enterprise agencies in different parts of the country. And we're relying on those enterprise agencies to apply their judgment to sort of target the support to viable, vulnerable but vital businesses. So talk a little bit about what I mean by that. So yeah, pivotal means different things in different geographies, and we'll take that into account in the assessment. But basically what we're getting at is the SME has to have local and national economic importance. So this might be based on employee numbers relevant to the relative to the area it's in. It might be around delivery of essential services or kind of wider economic community social value. So for example, it might be supplying to the NHS in the local area. We're also thinking about the company's integration within local supply chains and sort of leverage on the wider business community. So we've set out the application process to be as simple as possible, hopefully, but we wanted to give SMEs opportunity to make clear their contribution to the economy and their community. So that's sort of, so we've invited them to provide evidence of links to key workers and key sectors such as food suppliers, or how they are sort of integral importance to local communities. So this is kind of bespoke grant, it's not a set amount of money. So the due diligence and the kind of checks around that are proportionate to the amount of money that's been applied for. So for grants up to £25,000, the process will be automated as much as possible. For larger awards, more detailed kind of scrutiny and due diligence will apply. And then for applications over grants over £150,000, they will require approval from Minister McKee. A few just other things to consider in this. So we've thought about levels of employment and wages in the local area. So the kind of key stipulation there is that companies employing less than 10 FTEs in city centres are unlikely to be successful unless they can demonstrate in other ways their kind of substantial impact on the city or the regional and national economies. So as I mentioned, these funds opened last Thursday. We haven't started evaluating the applications yet, but we expect significant demand. We had quite a few sort of technical issues when the funds went live on day one, and we've already had over 1,000 applications submitted. So we expect these funds to be in quite high demand. So kind of that's a sort of run through the £45 million Pivotal Enterprise Resilience Fund. I'm hoping that Stephen might have appeared now and can talk a little bit about some of the other government schemes out there.
Stephen's managed to join us on audio. Stephen, can you hear us?
Yep, I can hear you. Can you hear me?
We can. Welcome.
Great. Thanks very much. Sorry, but I'll be really comforting to everyone that I'm the head of SG's Digital Economy Unit. Battling Zoom, and as ever, our laptops don't sort of facilitate useful technology. Sarah covered really well there from what I heard, the PERF fund. I think that probably the main thing that I would like to get across, I think, today is that, can everyone still hear me? Sorry, there was a strange little noise there. The main thing that I would like to get across is that what the Scottish Government is trying to do is essentially fill in the gaps that we see in the UK Systems Fund, the various funds that have been launched. So, for example, the schemes that Sarah's just described in the wider £100 million funds that have been made available try to look at CBILS, which is the kind of major scheme that's been launched that doesn't really seem to be working in the way that was originally envisaged. And similarly, the UK Future Fund, so my team, along with Sarah's team, is looking at that really closely at the moment, and we've had feedback from Jane and others who are active in the digital tech sector, including the sort of early stage part of that sector, which suggests that maybe it might not be a fantastic support for businesses in Scotland, just due to where the thresholds are set. Ivan McKee, Minister for Trade and Innovation, wrote to the Chancellor at the end of last week just setting out some of those concerns, and I'm happy to sort of share that letter with the group. We understand from sort of various channels with the UK Government and other stakeholders that fund is likely, just as CBILS has been reformed extensively. We understand that the UK Future Fund might also change a fair bit as time goes on. What we are trying to do is lobby to make sure that those changes match what Scotland needs. So it would be good to hear, once the sort of SG contribution to this discussion is finished, if you get any ideas on that. We are very receptive to listening. Beyond that, just as I said right at the start, we will be looking at the UK Future Fund, especially once it's revised, to figure out where the gaps are for Scotland. And without sort of making any major promises today, we will be looking at how those gaps can be filled. So again, if you have ideas about that, it would be really helpful to hear. We don't think the Future Fund works for reasons of the the threshold's been a bit too high. We think that it might be difficult for businesses to get to raise £125,000 minimum of external private funding. And we also question some of the terms. So some of the terms are pretty poor for the founders, and you can see quite a lot of press coverage about that, even just this morning again. So I think Jane, those are the kind of main things. It might be helpful to sort of open it up into a discussion and to hear from the group about what they see as the gaps for the digital sector, and how the Scottish Government can play a role in seeing if we can fill those gaps.
Absolutely, Stephen. We've got Paul Atkinson and Chris Thompson on as well. And gentlemen, is there anything that you would like to add to the information that you've heard from Sarah and Stephen this morning?
Yeah, James, Paul. Well, first of all, the Pivotal Resilience Fund, I think, is an excellent addition to the portfolio of support measures, and I thank the Scottish Government for doing that. Coming on to the Future Fund, I think one of the principal challenges, as we discussed in our panel last week, is that the vast majority of early stage equity funding going into technology companies in Scotland is enterprise investment scheme based.
Yeah. And
the Future Fund, it doesn't fit with that very well at all. So both in terms of people who've already invested, as in convertible loan notes, can actually poison the tax relief that people have already had. But also it also precludes them from doing future EIS investment following the conversion of the loan. So I think there are some technical difficulties, which I'm sure Chris will come on to, but there are some technical issues with the current presentation of the fund that means it doesn't fit very well with our, really, really active angel syndicate network in Scotland, and Scotland's got more active angels than anywhere else in Europe. Unfortunately, the vast majority of that funding is done as enterprise investment schemes, not loans, and very few of the angel syndicates or indeed the VCs supply loans.
Yeah, just echo Paul's statement. I understand some Brown, a lot of our clients that we've advised through fundraising rounds. The majority of that is angel or smaller VCs that are investing through the EIS scheme. So seeing that those would potentially be problematic in the future fund is it's not something that we were too heartened to see. Obviously, the fund, the idea behind the fund is a good idea, but it's making sure that cash can get into the companies that they really need it, and a lot of those are EIS backed businesses.
So, Jane, if I can say, I think it would be helpful, Jane, if I send you the letter that Mr. McKee sent.
Yes, that'd be great.
Maybe circulate it, because we are absolutely all over that. I should have mentioned the EIS point right up front. So that's something that we are really conscious of, that the Scottish equity market is essentially reliant on that form of investment, and where that it's not that form of investment, quite often it's Scottish Enterprise through SIB that are providing the investment, and it's not entirely clear that investment counts for the 250,000 threshold. I guess what would be really helpful is to have a discussion about, I don't know if there's time just now, but at some point certainly a discussion about what could the Scottish Government do to sort of fill in those gaps, again without making huge promises. I'm not sure if it would be loan or grant, but we are certainly really keen to engage with the early stage sector and investors to figure out a scheme that would work a little bit better for Scotland. Of course, the first protocol, as I said, is always to sort of lobby the UK government and make sure that funding works as well as it possibly can for Scotland, and then for the Scottish Government to sort of pick it up from there and try and make it work. Grants are tricky in this environment. I'll just be upfront about that. There isn't a lot of resource funding kicking around the system at the moment, especially after all the kind of bullets that have already been fired, if you like. but are there ways that we could use sort of capital funding, R&D funding, things like that? Is there ways of using loan or equity funding in a more sensible way than the UK government's chosen to? I've said that so we're picking up that they will be keen, keen's maybe the wrong word, they will be willing to have a look at whether or not the scheme should change, because I understand it's not just Scotland, but they're also getting a lot of lobbying from Belfast, Manchester and the Midlands about this, essentially the kind of the decently sized regional tech hubs out with London. But one thing we're hearing, and again a lot of this is sort of conjecture and rumour, but we'll see, but we're hearing quite strong indications that the EIS part of the scheme is one thing that they may not be willing to change, because they view it as like sort of a double benefit from tax relief. And I know that a lot of people would disagree with that, and we may well too, and may press on that point again. But yeah, Jane, so really just any help with what a useful Scottish scheme could look like that sits alongside the UK Future Fund would be hugely helpful for us.
We can absolutely do that. I think Paul and Chris may have some thoughts on that just now.
Yes, Stephen, I think it's really good to hear that we've got an open forum to discuss it. I think probably the best bodies to give that input, Stephen, is Link Scotland, which is the umbrella body for all of the angel networks in Scotland.
Yep.
And some of the regional VCs that operate these EIS investment schemes. So it's probably too much content and too much detail for the call, but I'd certainly be up for contributing to that, Stephen, and maybe getting the Link Scotland team hooked into it, if that's okay.
That'd be fantastic. That'd be great. There was one other thing, Jane, I just wanted to get across that isn't so much about the business support part of it. It was just more to indicate, so some of you will know, Jane will certainly know that since Kate Forbes became Cabinet Secretary for Finance, she persuaded the FM to let her keep the digital economy portfolio. It's something that she's hugely passionate about, and we have been given a very, very strong steer from the Minister that is part of Restart and Recovery economic policy. She wants digital technology sector to be right at the heart of that, and in particular to start to look at the early stage side of that, and to start seeing what government can do to be more active in supporting the kind of ecosystem to be better. How can we attract more investment? How can we generate a stronger pipeline of investable companies? All of that stuff. And you may well, so I'm going to be a little bit enigmatic here, but you may well hear more about that this week and possibly even tomorrow. So we are definitely looking for ideas. We're on the lookout for new policy measures that could be taken to sort of stimulate the digital side. So as I said, that's both the tech sector as a kind of economic proposition in its own right. But the second part of that, I think, is really interesting and important as well. And Jane, again, it's something we've talked about a lot, but it's about how do we use the innovative sectors of our economy, tech obviously being chief among those, to stimulate the bits of the economy, the sectors of the economy that aren't so good at sort of embracing technology, that aren't so good at improving and boosting their productivity or investing in research and development. Are there ways that we can sort of connect those two worlds that sort of drives an economic win-win? So, you know, these companies benefit from innovation and becoming more productive, and obviously the digital world benefits from new contracts in a sort of more technologically savvy sort of business space who would be looking to employ their services. It's just, so we feel as though this is a really, really big opportunity to sort of drive that. It's something we talk a lot about in government. It's not an easy thing to actually solve, but if there has been any benefit, which seems like a weird thing to say from coronavirus economically, it is that companies have been forced to innovate. Companies have been forced to adopt new technologies and new ways of working and to diversify the products and services that they offer. So the thought is, how can we sort of capitalise on that? How can we continue companies on that sort of journey? So again, if there are ideas or thoughts about how we can achieve that, again, that would be gratefully received.
I think that sounds really interesting, and I mean, you know, we'll make sure that Paul is connected in so we can help with the specific view from the angel and investment community. But in terms of the broader questions there, as always, we're more than happy to throw those open to our membership and the cluster ecosystems as well. So I think we will follow up on that one for you and with you and make sure that we get some interesting input and ideas from industry. We've not got any specific questions that have come in so far. So if we've covered those points, then I would like to welcome and hand over to Paul.
Jane, do you mind?
Sorry, go on, Stephen.
Nothing on, sorry.
No, go on, Stephen.
Sorry, Stephen. No, it's fine. We did say at the beginning of the session that you would have to drop off early. So
Sorry.
Thank you very much for joining us this morning. We'll pass on any additional questions that come in.
Much
Yeah,
appreciated.
thanks, Stephen.
Thank you.
Morning, everybody. I'm Paul Atkinson, one of the founding partners of Part Equity, which is an Edinburgh-based venture capital business. I want to start off just by setting a bit of a business backdrop. I'll come on to talk about the VC and angel markets and PAR specifically. Also, I'll talk about our source of funds, including BBI, which Jane mentioned earlier. I'll say a bit about the kind of things that we're interested in and how you can apply if you're looking to raise capital. I mean, in terms of the business scene, I mean, lockdown has created extreme business challenges for most businesses, with many believing that this will lead to lasting changes to the way we operate as businesses and how we manage in the future. Interesting this morning, that was a note in the Insider magazine from the IOD, courtesy Malcolm Cannon, saying, and they've done a survey of hundreds of businesses, and 4 out of 10 said their companies had made adjustments that they intended to keep post-COVID, which is a pretty interesting statement. Increased focus on digital services, that's pretty obvious. Increased working from home, more use of online training. The increased working from home is interesting because the vast majority of SMEs that I'm talking to who are looking at new office space are now going to commit to sometimes less than half of the office space. And that's a pretty interesting trend. So that's going to lead to less demand for commercial office space. I actually genuinely believe there'll be much decreased business travel in general, and people are much more used to using these kind of tools. And when we are considering investments, these kind of business backdrops are quite important. But businesses have been innovating during the lockdown. According to the IOD, 1 in 6 of those polled have already launched a new product or service. And an oft-said saying is, necessity is the mother of all invention. And certainly from a PAR perspective, we expect a flurry of new business ideas and business models to come forward as lockdown eases and business starts to get back to normal. I think we'll see some really exciting opportunities, actually. I mean, in terms of economic activity, one of the big four in a report I saw at the end of last week was suggesting that this year would see an outturn for Scotland of minus 8% on GDP. Bear in mind, the first quarter was positive. I don't know whether that implies a further 10% decrease. I suspect this quarter is going to be a lot worse than that. But by the end of 2021, we'll have seen a plus 8% bounce back. Basically saying that by the end of next year, we're back to where we were at the start of this year, which is pretty interesting. But I think it will affect different sectors differently, and some sectors will emerge a lot faster than others. And I think technology will lead the way. But as you would expect, anything to do with travel, hospitality is going to be a trailing return to the norm, I think. All of that, I think, means there's going to be quite a lot of good business opportunity for ScotlandIS members, given that we're largely focused on technology. Moving on to the VC and angel markets, it's fair to say most angel networks and VCs are still in the game. They're just being more cautious, and deals will take a bit longer to conclude. There's a recent survey done by a firm called Bohurst of the European market, which kind of suggested that probably more than 50% of the liquidity in the markets on the sidelines at the moment. So you can expect capital being deployed over the next few months to be down substantially, but it will probably bounce back as things become more certain, the money's not gone away, it's just been put on the sidelines for a while. Most of the deals that have been concluded in the last 6 to 8 weeks are things that started pre-COVID. We've closed 5 deals since lockdown as part equity. That's 12 deals we've closed since Jan 1 this year. But all those deals started pre-COVID. We are looking at new things right now, which I'll come on to. But if you're applying for funding from an equity player's angel syndicate or VC, it will take at least 3 months from start to finish, and probably in the current climate longer than that. So you need to start early, which kind of means that if you start looking right now for funding from an angel or a VC, it's going to be August, September before any money lands, even supposing you're successful. So bear that in mind. We've covered some of the government support measures. I mean, in terms of source of funds, well, first of all, the core of our offering is we have a very active angel syndicate with professional investors. It's about 200 people in total. We're always looking to add to it. And that syndicate both brings financial capital and horsepower to place into companies, but also intellectual capital. And that syndicate helps define the kind of investments we make. They bring deal flow to us, they sit on boards for us, and they help us analyse and diligence the companies we want to invest in, so it's pretty key. And sitting alongside that, we have a very active EIS fund, which distributes its product out to the main wealth managers and IFAs across the UK, organisations such as Tilney. We've got Scottish Investment Bank here locally, and PAR is one of the kind of key partners. They're able to match fund on the same terms as ours in any deal we go into, but it's only focused on Scottish headquarters businesses. And now in terms of the BBI offering, which we've recently been allocated, it's fair to say the BBI product we're now running with started with a conversation over a year ago, so it's actually nothing to do with COVID and lockdown. It's actually to do with supporting regional angel programs. We were the second one to be allocated capital. We've been allocated £15 million to deploy over the next few years in any UK company. So it's a UK-wide prospect for us, and they can match between 20% and 35% of PAR's investment in any one company. It's been extended to a higher percentage in the short to medium term, really to take account of COVID. So we have been given more flexibility in the short term to use that money. And the vast majority of PAR investments, as we talked about earlier, are into EIS qualifying businesses. And to be clear, we're an equity business, not a business in the business of providing loan capital. So convertible loans wouldn't be ordinarily an instrument we would look at, because it basically undermines enterprise investment scheme. It's a technical issue, but it does undermine enterprise investment scheme investments. It might be interesting to see where we get to in the discussion with Scottish Government, and it might hopefully be helpful that income tax is a devolved power in terms of resolving some ways forward on that. I guess watch this space. Now a sweet spot is investing between £500,000 and £1.5 million. We tend to be the second or third money in, not the first, and we usually expect to provide 2 or 3 more follow-on rounds of investment. I mean, in terms of the things we're interested in, we're looking to back defensible technology-related IP and business models that have got some kind of international reach and potential, with the ability to point to commercial traction. So it's unlikely you'll see us investing in absolute startups. With the slide deck, most of the companies we invest in have at least got a minimally viable product and can point at some early commercial traction with companies. We are generally still investing in companies that require equity capital to get across the chasm from losing money to making money. And we tend to invest in product rather than service companies. I mean, a hot space really is business-to-business SaaS, medtech, fintech propositions, AI and data-driven prospects. And examples of recent deals include ECOG, which we closed out in the last couple of weeks. ECOG is a subsea battery technology business in the North Sea. Unique Lasers was last week, which has got very novel laser technology being applied to quantum computing applications. MPT, which is in the biomass fractionation and recovery business. Earth Rover, which is robotic farming. Mauser, which is kind of retail data business that we're invested in. we're currently looking at companies in the kind of reg tech space, DLT, that's distributed ledgers, blockchain, as some people know it. And we're also looking into an AI chatbot business at the moment, which is pretty interesting. I mean, for those on the call who want to apply for funding with Part Equity, there's a link on our website. That link feeds into our investment committee process. In the first quarter of this year, we reviewed about 170 prospects, and I think this quarter will be about the same. So we're getting through 170 applications a quarter, and we expect to invest in between 5 and 6 new companies between now and the end of this calendar year. So we're very definitely open for business. The investment committee process makes a final decision on what we're investing or don't invest in. We use our professional investor network to help with diligence. It's a pretty straightforward process to go through that program, but we do have responsibilities towards our investors to make sure we've checked out all the details behind the investment we're making. So I guess in summary, we're very definitely open for business. BBI scheme definitely helps that from British Business Bank, and you know, if you want to connect with PART, apply for funding, please do through our website, and I'll be happy to pick up any questions through the panel towards the end of this call. Thanks.
Oh, thank you very much. That's been really interesting. I think I'm jotting notes as you're speaking as well. I'm always looking for positive news at the moment. I know we need to be realistic, but it's really good to hear about some of the positive changes and that so many companies are innovating. I think even I, the eternal optimist, was heartened by 1 in 6 developing new products and services at the moment. That's phenomenal to hear, and it just shows the resilience and innovation that we see across the different technology industries as well. If we have Q&A come in, I will feed them in at the end, but now I'd really like to welcome Chris Thompson from AAB.
Thanks, Jane. I'll just share my screen. I've got some slides. I hope you can all see that now. So, hi, I'm Chris Thompson. I'm a senior manager in the corporate finance team at Anderson Brown. Like most advisors, the past couple of months have really been focused on supporting our client base navigate through the various government support packages that have been announced. And you'll no doubt be aware that the past few weeks have seen a range of new measures being announced or improvements to existing schemes. So it's really important to continue to arm yourself with all the latest information around the support that's available to your business, and hopefully these slides will provide you with some further insight into these. Happy to make these slides available. I've made them fairly detailed, so hopefully they'll be of use to everyone. So just a quick overview of the support measures I'll cover, focus mainly on these SME schemes. And these are the business support fund grants, the bounce back loan scheme, and the coronavirus business interruption loan scheme.
Sorry, Chris. I can't, it might just be me, but just to check, I can't see the slides, and I don't think Katie can either. Paul, can you see the slides?
No.
Chris, could you try and share again? Apologies.
No problem, I'll try again. Is that working now?
Perfect. That's great. Thank you so much.
No problem. There wasn't much missed, so that's just covering those 3 that I will go through. So the first one, moving on to the next page. This is the business support fund grants. It's announced as part of the initial package of support measures by the Scottish Government. And there's 2 types of cash grants introduced. So one for small businesses and one for businesses in the retail, hospitality and leisure sector. So businesses who qualify currently for the small business bonus scheme or rural rate relief are able to claim a small business support grant of 10,000. So that the eligibility for this is that if you've got a combined rateable value of all your properties of less than 35,000 and the rateable value of an individual premises is less than 18,000, you'll be able to claim that 10,000 grant. Unfortunately, at the moment, it doesn't capture many small businesses that work from shared offices, which I know many technology businesses will do. But there has been an announcement by the UK government on Friday to pledge further support to plug a gap in this, although this is only for English businesses, so we'll need to wait and see if the Scottish Government follow suit and offer that up. There is a larger cash grant of 25,000 for those in the hospitality, leisure and retail sectors, with rateable value of less than 51,000. And again, appreciate, I suppose, many technology businesses don't fall into this scheme, but you may have customers or friends and family who are currently struggling with cash flow that may be eligible, so should maybe consider looking into this for them. And as I briefly touched on, the grant scheme in Scotland is administered differently than in England, and it's brought up some disparities between businesses. So, for example, a business with multiple premises south of the border could apply for additional grants for each property, whereas in Scotland it's only been possible to apply for one grant, no matter the number of properties. That is due to change as of tomorrow, so the Scottish Government have increased the net. There's going to be sort of reduced grants made available to businesses that still meet the criteria but have more than one property. The reduction is 75% of the first grant, so 7,500 for every additional property eligible for the small business grant, and 18,500 for the retail, hospitality and leisure support grant. Still means that Scottish businesses are going to receive less than those south of the border, but does go some way in closing the gap. And application forms can be found in your local council's website. So yeah, just check those websites. I know some councils have been better than others at distributing the grants, and some of the larger councils have taken quite a while to get cash into to the businesses' pockets. So my advice would be, if you're eligible, just try and apply as soon as you can. I'll move on to the next scheme. So this is the Bounce Back Loan Scheme, officially launched today, so don't know yet how effective it's going to be, although it's definitely been welcomed by many in the business community. The scheme is provided by the British Business Bank through participating lenders. I checked the website this morning, and there's currently 10 lenders accredited for the scheme, which are all the main high street banks who are currently lending through the CBILS scheme, which I'll touch on later. All look like they're only offering it to existing customers at this stage, so we need to see if any other lenders do become accredited to hopefully widen the net. The scheme itself provides the lender with a 100% government-backed guarantee for loans between 2,000 and 50,000. The loans are going to be capped at the lower of either 25% of turnover or 50,000, but there's no size limit to the businesses that can apply for the scheme. But obviously it's geared towards those SME businesses that will really need it. The government cover the first 12 months of interest payments and any lender levied fees, and they've announced that interest rates beyond the initial 12-month period that's covered by the government will be fixed at 2.5% per annum. So it means that every successful applicant will benefit from the same affordable rate of interest. Loan terms are up to 6 years, and interestingly, the first 12 months will be capital repayment free, and you're allowed to pay off the loan early without any early repayment fees. So there's definitely potential for businesses to take this out as an insurance policy for 1 year and repay the loan without any interest or penalty payments should they not actually require it. A business will be eligible if it's based in the UK, has been negatively impacted by coronavirus, and you have to self-certify that is the case. and it also hasn't been an undertaking in difficulty as at the 31st of December 2019. Borrowers, once they go through the process, should find a very short application form in which, as I mentioned, they'll need to self-certify that they've been a viable business and that they've been impacted by coronavirus. But what it does do is mean that it lifts a lot of obligations on lenders to carry out their own checks, and should hopefully speed up the approval process. Businesses are excluded from applying if they've already received a loan through CBILS. If you have received a loan through CBILS under 50,000, you are able to arrange with your lender to transfer this onto a bounce back loan scheme. As businesses are excluded from applying for a larger loan under CBILS, if you already have applied for a bounce back loan, you need to have sort of careful consideration as to how much funding you actually need. If it is over 50,000, then you should be considering CBILS rather than a bounce back loan, as you won't be able to benefit from larger amounts covered by the government, those of interest payments. In the past week or so, we've seen a number of banks suggest to businesses to look at the bounce back loans instead of CBILS, where the loans were up to about 50,000. Obviously, it's a benefit to both the borrower and the lender, as there's lower interest rates and the government are backing the full amount should the borrower default. But our understanding is that those lenders who are offering bounce back loans will probably increase the lower limit for CBILS to 50,000, so that both schemes are not competing against each other. And I'll move on to the next slide. So the next scheme is CBILS. Probably had the most scrutiny in the press over just around the sort of time taken to get money into the cash, onto the hands of SMEs that need it most. The scheme's been open since the 23rd of March, and across the UK, the latest figure was 4.1 billion has been provided to SMEs, but that was after a very, very slow start. Banks do appear to be finding their feet with the scheme, which should hopefully mean that the application process is getting easier and quicker decisions are being made. There was a significant backlog in applications initially, and I think banks are still working through that. So hopefully the process is becoming a bit more sleek as we go on. As with the bounce back scheme, it's provided by the British Business Bank through participating lenders. The number of lenders has increased since it was initially announced, and it's taken the number to over 50 at the moment. So obviously a lot more than the bounce back scheme. This scheme provides the lender with a government-backed partial guarantee, so they guarantee 80% of the outstanding facility balance, although the borrower still remains liable for 100% of the debt. The maximum value of a facility under the scheme will be 5 million, although banks are limiting facilities to 25% of your FY19 turnover, or around 2 times the annual wage bill. But clearly, you can take on a lot more debt than you can through the bounce back scheme. The government are going to cover the first 12 months of interest payments and any lender levied fees. So the benefit, the business will benefit from lower capital only repayments in those first 12 months. Although what we've been seeing is that a lot of lenders are offering initial repayment holidays for the first 6 to 12 months, depending on the term of the loan. And after initial controversy, and as Stephen mentioned earlier about the scheme has been amended a number of times. Initially, the scheme lenders could ask for a personal guarantee, but that's been limited to any lending under 250,000. There can not be any personal guarantees sought from the lenders. Above 250,000, they can seek personal guarantees, but these are capped at 20% of the outstanding balance after any proceeds from business assets have been applied. Financing is still received from the lender, not the British Business Bank or the government, so you're still going through the lender's normal credit process. So you need to approach them in the first instance. And what we've found initially is that most lenders are focused on their own customers. So if you are wishing to apply for a loan, speak to your incumbent bank in the first instance. Unless a business's current lender is not a participating lender under the scheme, banks are pushing back any requests from new to bank customers. Whether that will change as the backlog of applications are cleared, and they may open it to new customers, that's yet to be seen. I know some banks are considering new customers under a case-by-case basis, but on the whole, it's mainly been existing customers that they've been processing through this scheme. And lastly, on this slide, the scheme is open for initial 6-month periods. There's no cap on the money being able to be lent through the scheme, so there isn't an immediate rush to apply. Should your business not require the funding in the sort of immediate term. The next slide just covers briefly the eligibility checklist. Won't go through this in detail. Happy to pass these slides on. I guess the key point to note for eligibility is that the group turnover can be no more than 45 million, and you must also have a sound borrowing proposal, so that the lender believes that the funding that they'll provide will enable the business to trade out to any short to medium term difficulty caused by the coronavirus outbreak. Businesses are also required to provide supporting documentation. Although for smaller loans, a number of the high street banks have relaxed the requirements, particularly around forward-looking forecasts, and the process should be a lot easier for loans under 250,000. Before we move on, just want to touch on a few key points to note on the CBIL scheme. Turnaround times on applications have been really mixed depending on the lender. But it's been the case for the majority that they're only looking for current customer applications. So make sure you speak to your incumbent bank as a starting point. Lending rates are driven by a risk and reward matrix. So just because the base rate is at all-time low, it doesn't necessarily mean that you'll get cheap debt if your business is still deemed risky. We've seen interest rates between 2% to as high as 12% over base rate, depending on the business and the perceived risk of that business. And although your business may currently be handling the outbreak well, you really need to consider what happens should your customers start facing difficulty. I know a lot of technology businesses haven't had a real impact to their business as yet in terms of trading, but are potentially starting to see customers delaying payments or cancel projects and spend later in the year. Just need to make sure that you understand where future issues may lie with your customers, because this could have a knock-on impact on cash coming into your business. Many businesses will be seeking a bounce back loan or a CBILS loan as a safety blanket should customers begin to be unable to pay under normal terms or reduce their trade later in the year, which could lead to potential cash flow issues further down the line. Businesses now should really be planning how they're going to exit this crisis, and just make sure that they've got enough cash reserves to trade through it. And that's everything from the schemes. I just wanted to touch on a few points of advice just around before you start seeking any of the government measures. First suggestion, seek advice as early as possible, either through your existing advisor network, local councils, business gateway, development agencies. The best thing you can do is just surround yourself with good advice, as it'll put you and the business in a far better position to tackle any adversity. Understand where the crunch points may arise, so adequately cash forecast over the coming weeks and months. Understand when cash is due to go out and when cash is due to come in, and it'll allow you to have quick conversations with your customers and suppliers, and just establish any funding gaps. This will hopefully prepare you for discussions with lenders should you wish to seek debt funding. Understand what's available to your business. So I've covered quite a few. Take advantage of grants and refunds or holidays from the government, or any payment holidays from existing lenders or landlords. If they're available, use them. It may be better than the long-term health of the business to choose these before taking on any more debt. Speak to your existing shareholders. If you've got any institutional shareholders, that they may be willing to plug any gap with an additional injection of capital, potentially by way of convertible debt or an initial equity stake. Just that they're able to move far quicker than an external lender. So might be your best sort of short-term funding opportunity. If you do need to take on external debt, just understand how much you need to get you through that short to medium term difficulty. It will help hopefully with conversations with your bank and ensure that you're well prepared, and also clarify which of the loan schemes you should be looking at, and whether you can look at the bounce back loan scheme over CBILS. And finally, I've touched on it quite a few times, but just make sure you speak to your incumbent bank in the first instance if you are looking to take on debt, as the majority of lenders are focusing on existing clients at this stage. And that is everything from me. Happy to pass these slides on to anyone that needs them. And thanks for listening, and I'll pass back to Jane.
Chris, thank you. That's hugely comprehensive information. And I've found that really useful because there's more detail and more covered there than in a lot of other things I've seen. So we'd be really pleased to be able to share that as well. Thank you. We have got some questions that have come in. I'm going to start in reverse order, actually. The first one's directly related to the information on CBILS. So question one is, CBILS small print regarding 50% plus turnover in the UK is disappointing. Is there any comment from the panel on this, or does anybody understand the logic for that? Paul, Chris, if you could.
Yeah, I think it's predominantly so that, I guess, overseas owned businesses aren't taking on the debt to then potentially use it elsewhere in the group, so non-UK for non-UK purposes. I've discussed with a lot of SaaS businesses who are not selling a tangible product, but are selling their software to businesses overseas. They will employ a predominantly UK workforce, so why should they be negatively impacted by this? I think it's something to discuss with your lender, and whether there's any way around this. It's disappointing in many businesses in the tech space. I just don't think the government have considered those businesses and where their income will be coming from. But the only logic I can think is just to ensure that the cash is going to predominantly UK businesses, and it's not going for going to help overseas operations.
Yeah, I think I probably agree with Chris on this. It's probably ill-founded piece of detail in the viability, which obviously mitigates against companies, UK companies, who legitimately have got the vast majority of their trade outside the UK. It makes no sense when you want to be a country that exports from here. It just doesn't make any sense. I think people should remember that with all of these loans, it is a loan that has to be repaid. And you need to be sure your business can withstand that repayment process in the future. And there's also some little kind of quirks of it as well. My recruitment business doesn't qualify because although it turned over 75 million in 2019, the turnover this year will be well below 40 million, but it doesn't qualify because we turned over more than 45 million last year, which is, that doesn't make any sense either. So there's many things about the detail of some of these schemes that don't make any sense. And I kind of suspect, much it would be unpopular to our Treasury officials to hear this, I suspect when we look back, the take-up of these loan schemes from the crisis, the take-up will be in the single-digit percentages, I think. I don't know what you think, Chris.
No, agreed. Yeah. I think that's, yeah, that will be the case. That will be the case.
Thank you. That it makes sense, and I do see the points you're making as well, Paul. There's yes, it makes sense on some levels, and it makes no sense on others at all. Potentially, I suppose, speed of response and trying to create the solutions leads to some gaps and some confusion in how it fits. We've got a couple of other questions in. One that came up, Chris, again during your slides around the CBIL one again, I think, which was what sort of companies wouldn't be considered viable?
Yes, so what we've heard from banks is that, you know, businesses that were loss making in 2019 are not, on the whole, being able to access the scheme unless they can demonstrate that, you know, it was a one-off blip, or there's some, you know, factors you can point towards, you know, the latter half of the year being more profitable. But on the whole, it's mainly been, you know, loss-making businesses in 2019 are not viable. You know, this can also be, you know, high-growth businesses that are looking to achieve scale, looking to grow revenue, you know, not looking at profitability in the short term, you know, but do have a viable business, being sort of let down by banks because they've not made a profit in 2019. If you have been loss making in 2019, it's worthwhile considering how can you dress up your numbers, how can you look at the performance last year. Is there any one-off impacts to the business that has caused it to be loss making? And hopefully that you know would be enough to you know get a bank round. I guess you also need to demonstrate that the business can come out of this crisis and be a viable business, which is very difficult at this stage. You know, a lot of bars and restaurants have no idea when lockdown will be lifted and whether they'll be able to trade, or you know they'll only be able to trade at, you know, 50%, 25% capacity to allow social distancing. So in all of that, it's just scenario planning and scenario forecasting, and work out how much trade you can get through if you know varying levels of lockdown are lifted, and just, you know, look to see what your business or how your business can come out of this depending on the various scenarios. Paul, I don't know if you'd have anything to add to that.
Yeah, I think the vast majority of Par Equities investments were loss making in 2019 because we're investing in growth companies. So virtually none of the Par companies qualify for CBILS. And I think that will be quite common with technology businesses that are trying to scale. It's really, I think CBILS is really pointed at small, medium-sized services businesses that have been trading for quite a few years, who can see how they would bounce back. I mean, ostensibly, my recruitment business will be an example of that, except that it would breach the turnover rules for 2019, sadly. Not that we would necessarily want to take on a sizable CBILS loan with PGs on it. We'd probably avoid that like the plague, if at all possible.
Thank you. It's exactly that sort of input and feedback that we've been trying to make sure that we collate and feed back to both the Scottish Government and the UK Government. You know, keep telling us, and we'll keep collating and we'll keep feeding it back, both on briefing calls weekly and formally in writing, and email too. So we have another question. Paul, I think one for you initially. For companies who were just ready to seek investors, are there still opportunities to build relationships with those investors, and if so, how?
Well, it doesn't actually say anything in the question as to the stage the company's at, but the first thing I would do is I'd look at the contacts and relationships that I already have with people who might be able to provide funding. And you may well find that some of your contacts are in our Power Investor Network, for example, or an investor network with Equity Gap or Archangel. Investors are generally more likely to look at something if it's introduced by somebody they already know. And I just go back to, we reviewed 170 business plans in the first quarter. We can't possibly form a relationship with 170 companies a quarter. It's just not practically possible, given that we've got most of 80% of our working week is focused on looking after our existing portfolio companies. So that's the first thing I would do, look at the contacts you already have, or your advisors. So your accountants and legal advisors, do they have contacts with the investor networks? Is there a warm introduction through that route? From a power perspective, we're always happy to field direct approaches via our website, and generally we can give you an answer within a week, 10 days, 2 weeks, as to whether it's it's a business that might be of interest to us. If the business might be of interest, we will contact you, and if you're not of interest, we will generally feedback as quickly as we can. But it's not our thing for whatever reason. It could be that somebody's raising too much money, too little money, it's the wrong stage. I've talked about some of those things. So we tend to be, we're not really in a position to fund more than about 1.5 million in a round. So if it's more than that, it's not going to fit. If it's less than 500,000, that's also difficult for us to fill, because we've got an EIS fund to deploy. So it's difficult for us to write a check smaller than 500,000. And we have to be able to point to some commercial traction. But virtually every company we invest in, certainly in the first round, is loss making at the point we invest. So that's not an issue. And we want somebody who's got defensible technology and defensible IP and defensible business models, and can build a moat around whatever their proposition is. So that's kind of what I would say. Build relationships if you can through people you already know, your advisors or other contacts you've got in your own network. We're happy to review business plans, but we do give more credence to things that are introduced by people we know who we count as being credible. So there's no doubt that if you have a warm introduction, it's better than a cold one. And it's difficult to build long-term relationship with investors if you don't already have one. You just have to go through the routes we've already said, because we can't afford to have meetings with 170 companies a quarter. It's just not practical.
So a top tip from there would be to use your connections and use your networks. That communication piece is incredibly important. So
it is. Yeah. I would also mention LinkedIn, by the way. People do tend to respond on LinkedIn, even if it's only to say, if you've got a brief description of your business, there's no problem sending it to somebody on LinkedIn and saying, what do you think? Could this be of interest? You can waste your time talking to a lot of people and not get anywhere if you don't talk to the right people. So I would say that you need to look at what you're trying to fund, and you need to try and do some research on which investors invest in the kind of things that you're doing. If you're looking to raise 500,000, there's no point in applying to somebody who only places £2 million checks. You're wasting your time. So you need to apply to people who are writing the right size of check and who have an interest in the kind of company you are. Generally, most of the investment groups have got lists of their portfolio companies on their websites, so you can see what kind of companies they invest in, and therefore make an assessment as to whether you think your company might fit the bill or not.
No, that makes sense. Chris, would you add anything to that?
Yeah, I guess it's just adding that VC and angel syndicates are still have cash to deploy, and are still actively looking for good opportunities. Obviously, valuations will potentially have taken a bit of a hit depending on the business. If the business is still robust, is trading through this period well, it'll still be attractive to those VCs, and we've been speaking to various PCs, and obviously part of invested in ECOG. So there's still investment opportunities out there from VC funds. So it's a lot of it is business as usual on the investment front, albeit working with portfolio companies to ensure that they're well prepared for the coming months. But just continue to, as Paul said, build those relationships, work through advisors or other ways into these VC companies and build your relationships. There's no point stopping just because of this.
Yeah, just adding to that slightly. I think one thing I would say, given what Chris has just said about valuations, which might sound really obvious, but if you don't need to raise money right now, you're probably better waiting until the market's a bit better. Because valuations will be lower now than they would be otherwise. So if you've got positive cash flow, you might want to choose a different time to raise capital. And the investors as they are will tend to support their existing portfolio companies first. So we always look for companies to have an 18-month, when we put money into a company, we always look for them to create at least an 18-month cash flow runway. And certainly when we started into the crisis a few weeks ago, when we ran a session purely based on cash flow, we were advising at that time companies should do what they can at this point to increase their cash runway for as long as possible.
Thank you very much. I think we've had a huge amount of information during the session. There are no questions coming in at the moment, but if they do, if you don't mind, we will pass them on and we will field them. I think as well as very comprehensive information from both of you today, we've also had some great advice and tips. Innovation is still happening. Use your networks, use your relationships, use LinkedIn. I like that one. I think people often forget about that one. That there is still investment happening, I think, is a really important message. It might be a little bit tougher. The terms might not be quite as good, but we are still seeing investment happening. We are still seeing new products, new services being developed and new companies forming even during the current situation. So I think that is a really important message to take from the session today. There is support out there. We know there are still gaps. If you know of specific gaps, let us know. We will feed those in. But I think the information from Chris today has been hugely useful in helping understand the landscape that's there, and from Paul in terms of the investment landscape. I think Chris's tip about speaking to your current lender, your current financial services provider is a really good one. And just make sure that you understand the terms and the fact that you are taking on, as Paul said, a loan, and that these do have to be repaid, and some of the terms are more favourable than others. Chris, Paul, is there anything you'd like to add just to round up?
I think, yeah, I suppose something that we are discussing with clients now is, we've passed the peak, apparently, in the UK of this virus. Lockdown will come to an end at some point, so just ensure that you have the cash reserves as you come out of lockdown. Furlough scheme is not going to last forever, so those fixed costs are going to start coming back. So just make sure that you do have the cash to enable you to trade as business as normal going forward, and that's where consideration over the grants, the loan schemes available should really take place over these next few weeks.
Yeah, I agree with Chris on that. Here we are. I think we're now starting to talk about business resumption, which is a really good thing. I am optimistic that there's going to be some great ideas come forward, and that technology will lead the way out of this. Certainly, that's my assessment of it. Well, lastly, thanks for everyone for coming on the call. Hope it was helpful, and thanks for Jane for hosting, and the rest of the ScotlandIS team. And very happy to continue supporting what you guys are up to. You provide a fantastic service and fantastic support for the community. Thanks, Jane.
Thank you very much. We didn't ask you to say that either, I would like to point out. We really do appreciate your time and expertise today. We'd like to just once more thank Stephen O'Neill and Sarah from the Scottish Government, from the Digital Economy Directorate. We'd like to thank Paul Atkinson and Chris Thompson as well for being expert panelists. And as we said, if you have additional points or questions you'd like us to capture, do let us know. Thank you very much, and we look forward to seeing you again soon.